As the conflict in Iran continues, one of the areas to focus on is the economic impact of being in a war like that. Pleasure to be joined right now by Kent Smetters, who is faculty director of the Penn Wharton Budget Model. Kent, thanks for a couple of moments today.
Yeah, good to do this.
Well, so I guess where do we start? Because there's obviously an investment made by the government in taking these actions and the resources that they're using. But
Yeah,
when you're thinking about the public back here in the United States, I think as simple as, gasoline prices and oil prices, the way they have risen sharply in the last few days.
that's right. So there's really kind of two dimensions to when we talk about the cost of everything. One is the budgetary cost, and we're saying, over the next couple of months, it really comes down to how much things are going to get escalated. We broke it down into four different categories of resources, and we're saying, maybe on the low end, it could be about $40 billion of costs. And that could go up on the very high end up to 95 billion if in fact by month two there are boots in the ground and so forth. Right now, this is more about not having that many boots on the ground. Our best guess right now, what we're using internally is around 65 billion. But when we think about the economic cost, and most of that's driven by higher oil prices. And so in the long run, by the way, the United States is actually better off with higher oil prices, believe it or not. This is very different than the 1970s. In the 1970s, we were big importers. Now we actually are big producers of oil and also big producers of the equipment. Think about fracking, for example, the equipment that actually goes into oil exploration and extraction. But the problem is that that takes a long time for that to happen. Oil prices have to be high for a long time, whereas in the short run, we're generally worse off because what happens, higher oil prices means gas prices go up, heating prices go up, the economy takes a bit of a hit. And so we're basically saying how much will GDP fall as a result of this over if this lasts for say a couple of months. We're saying it could. Our best guess right now is about $115 billion, which in a $30 trillion economy, that's not a huge amount. But on the low end, about 50 billion. On the high end, as much as 210 billion in GDP loss. It all comes down. I mean, right now, the futures market actually has a 20% chance that oil will exceed $100 per barrel. And so that's where you can kind of get those higher end numbers.
But even with the 110 or $115 billion number potentially,
Yeah.
as you kind of alluded to, we are also in a time where we are continuing to see the country's deficit grow and grow and grow.
Right.
And here we are adding, 100+ billion dollars that we were not expecting to add in probably, 3 or 4 months ago.
Right. And part of that is when it comes to the budgetary costs, yes, we're basically saying between 40 and 95 billion, probably our best guess right now, 65 billion. And a lot of that is just the replenishment of munitions and things like that. Obviously, there's deployment costs and so forth. We have these four different categories. And it is true when it comes to replenishment of munitions, it actually turns out how fast you do that. It really affects the cost a lot. If you really want factories to replenish within a couple months, they have to pay a lot of overtime. They have to really crank up things, and those costs really go quite high. But if you're willing to wait a year to replenish, it can be kind of spread out a bit. But the United States being a bit low on munitions to begin with, they're going to have to replenish pretty fast.
So then when you think about the different dynamics and segments of the economy, where is the greatest impact as we move forward here? Obviously, that as you alluded to, the timing of this is very important,
Yeah.
depending on how long this continues.
That's right. We're saying right now, it's going to be at least 2 months, and so where these are conditional on 2 months, we obviously know this could go longer. On one hand, this is not Venezuela. On the other hand, it's not Iraq. It's something in between those for sure. But nonetheless, this could go on for longer. And I think we are going to take some hit to the economy. It's going to be a bit negative, and the biggest hit will be in the form of gas prices or heating prices. Fortunately, mostly beyond winter at this point, but nonetheless, those are going to be the biggest impacts. So there's definitely a lot of upside uncertainty there. To be balanced, though, I mean, in all of this, I mean, this is the problem with security investments is that they
Yeah.
they they always look bad, right? Because if you're actually successful, people say, "We spent all this money and nothing happened." Well, that's the whole point of security investors. If Iran actually did get the bomb and, they were clearly had the enrichment capacity for a bomb. And yes, you said, well, we had those inspections years ago.
Yeah,
We all know how easy it is to
yeah.
fool those things. Even the inspectors themselves are saying we're probably not seeing everything. If they really did get, these 13 bombs, which was the estimate of capacity, even if they only had a 10% chance of using those bombs, the cost of that, the expected cost of that is just tremendous. And so, from a cost benefit perspective, we're not saying that this doesn't, pass muster. It could easily pass muster, but the point is that there is a cost.
What is there an area that maybe us as the public or even myself as a journalist that is going to be impacted that we don't necessarily think of, that maybe is kind of underlying as something that's going to be impactful in terms of financial as we move forward here?
Yeah, it's a great question. I mean, there is always those unknowns, and higher oil prices will also mean, airline costs as
Yeah,
they've gone up with demand and
yeah,
so forth. That this will be a negative supply shock, and so that will help drive up costs. But at the same time, less quantities will be sold there. So I think anything that kind of depends on oil prices in the short run will be negatively impacted. If this really does sustain higher oil prices over the longer term, believe it or not, that is actually usually a positive for the United States because we're a big oil producer now. And also we produce all the equipment that, fracking was a US thing.
yeah.
And so that often is very positive, very different than the 1970s. But it's more of the scenario that we're planning for that oil prices may not be high enough for a long enough period that there's going to be a lot more equipment built. Or, well, you don't uncap wells
Yeah.
very quickly unless you know oil prices are going to be up there for a long time.
I'll finish on this quickly, but what about the impact on the Federal Reserve and their decision making process? Because I
Yeah.
think the loss of GDP plays into a role there.
Yeah, and in particular, how the GDP gets lost with this negative supply shock. And in particular, that will definitely be inflationary, not deflationary. And so it's, when we have negative demand shocks, that tends to lower GDP and lower prices, or that is place less pressure on inflation. When you have these oil supply shocks, that
Right.
we typically think these are negative supply shocks, and that actually lowers GDP and raises prices. So all the more reason that they probably be pretty modest in their rate setting going forward, and probably are not encouraged to lower rates.
Kent, great to talk to you as always. Thanks very much.
Pleasure.
Thank you. Kent Smetters, who is faculty director of the Penn Wharton Budget Model.